Hello and welcome to the School of Stocks. I'm your host, Victor Dongo. Today we shall be talking about EBITDA. I call it fraudulent EBITDA. Follow me on this journey to understand why I call it such. For those that don't know, EBITDA is derived from the income statement, and it is a tool used for evaluation, often by those who want to earn a fee, who are the middlemen or those who are trying to package the deal to look very awesome in the presence of either the seller and most certainly the buyer, such that he is going to open his wallet and pay an exorbitant price for the acquisition. What is EBITDA? EBITDA is earning before interest, tax, depreciation, and amortization. It's quite a mouthful. That is what it's meant to do to you, so that you would swallow it without understanding exactly what it is. Let's give it the breakdown. Remember, when we did our income statement, we had revenue. Of this revenue, we separated the cost of goods sold, we separated our selling, general administration, and all other expenses, and then we arrived at our operating profit, and then we had our interest deduction, and then of course tax, before we got our net profit. Now, what this doesn't tell you is that the components of all of this, starting from the very top, revenue, can be massaged, can be managed, can be staged to create the impression that it is not. Imagine companies would stuff the channel. Stuffing the channel means that their products, they will give it to the distributor. He will not pay for it. He will not even want it, but they will tell him, take it so that we can recognize the revenue. Some other companies go to the extreme of asking the distributor to go book warehouses where they, the company, will stuff these goods right there, and as well book the sales, all just to make things look very fantastic on paper. Cash is king. Did they get the cash for that transaction? No, they didn't. Some of these products can eventually expire. Who takes the loss? The loss comes back to the company, not the distributor who didn't want it. So that is a way that revenue can actually be increased to take care of the net income and make it look really big. There are other instances that a company can just write invoices and attach it to a distributor's name. Yes, they do that just to show that they have they recognize that revenue. In many cases, some of these distributors don't even know this is what the company has done on their behalf. In that case, that recognized revenue is fake, all just to make EBITDA look real good. So, moving on, it means your net earning is fake. Now, EBITDA also adds interest to the value. Who owns the interest? Let me ask. The interest expense is not your money. It's not the company's money. it is somebody else's money. So how can you add somebody else's money onto your valuation metric? So if a company pays plenty interest, does that tell you the company is more valuable? No. It tells you the company is struggling. That is why it's paying big interest. So why would you now add an interest that belongs to somebody else as a tool to measuring that company that you are trying to sell or to buy? So really, this should not be there. It doesn't belong to the shareholders. It doesn't belong to the company. So you cannot add it to valuation metric for that company. 3, tax. Who does the tax belong to? It belongs to the taxman. Again, this does not belong in that transaction. It does not. Because, of course, this is not for the shareholder, it is not for the seller, it is not for the buyer, it is not for those involved in the transaction. So this does not have to be here to build up this value. No. What is depreciation and amortization? These two are non-cash charges. What do non-cash charges mean? It means that they are things that you have paid for before, you have owned, now you are expensing in the course of your business. So the cost has already been incurred previously. If this is very big, it means that the cost of maintaining, the cost of carrying on that business is quite high. If your depreciation annually is, let's say, 100 million, it means that you need to find somewhere around that amount to keep maintaining that business. So if the day you don't have the 100 million to maintain annually that business, you begin to lose your competitive advantage. What I'm trying to say here is, the bigger the depreciation and amortization, the bigger the previous costs that have been incurred in establishing this business. And it means that the bigger the cost you are likely to incur maintaining this business as a going concern. All in all, EBITDA I will present to you as management of fake earnings that has not been properly adjusted for the wrongs of the working capital. You then add the interest that does not belong to you. You then add also the tax that does not belong to you. And then you again now add the depreciation, the big expense that you have incurred previously, to now get a ballpark figure of, say, 1 billion. And then when you are finished, you tell somebody, for you to buy this company, pay times 4 EBITDA. So you're telling me the company is going to be worth $4 billion. Of course, that $4 billion, the people in the middle would go, let's say, 1% on the deal. So it means those who put the deal together would be sitting on roughly $40 million. If the deal gets really bad and your EBITDA, you you were able to get just 1 billion as the price. What they do is $40 billion comes down to $10 billion. So you see that everyone in the middle, the seller, everybody is incentivized to make this go to even $7 billion, so that because they are working on percentages, they can cream off a large amount. This is a problem with negotiated purchases of companies. And then eventually you see the company that you bought for $4 billion is not performing well. You begin to ask yourself, how did you get it so wrong? You got it so wrong because you paid too much price as a multiple for the things that does not belong to you. Thank you for listening and have a wonderful day.